All right, we're getting ready to go. Getting ready for our live stream. Welcome back, investors, to our second market close live stream. I'm glad you're joining me today. Yesterday was our very first market close live stream, and we had our very first blooper. When I was reading the Tesla delivery numbers for 2021, I was actually reading from 2020. Glad I caught that mistake. That was a pretty big blooper, in my opinion, for our first episode. I'm hoping, fingers crossed, we don't have another blooper like that today. So we're going to get into this, and just as a reminder, we have a bit of a format here for our live show. First, we're going to talk about the market. I'm going to give you an overall kind of market recap, how the day went, what I think about the day, what I saw, what was good, what was negative. Also going to talk about, in our second segment, we're going to look at the sticks. We're going to talk about stocks that did well today, and then look at the losers for the day as well and see what we can learn from that. Our third segment is to dive into a topic or two. We've got Pepsi's earnings to look at today. We've got Open Door building a war chest that's pretty large. We also have Gen X, and their wealth over the past year has exploded. So we're going to look at those few things. We'll also look at the S&P 500, and is there a pattern? Is the rest of the week going to be green, or is it going to be red? And then finally, our fourth segment, and each of these are about 15 minutes long. Our fourth segment will be answering your questions. If you have a question, leave the ticker symbol in the comments with your question, and we'll answer it live while we're doing the stream. If you happen to catch the rewatch of this live stream, you can also leave a comment with your ticker symbol, and we'll go over that in our next live stream. So that's kind of the format that we're going to follow. Obviously, we're not going to follow it to a perfect T, but we will get really close, or as close as we can, to following that format for the market. Let's just pull up the chat here to make sure that's open and going, and we will get started on this. First, talking about the market. All right, so the chat is up. Remember, just leave your comments in the ticker symbol, and we'll go over it live on air. So first, let's talk about the market. So if we pull up how the markets did today, we've got the Dow Jones up almost a full percent, 0.92%. The S&P 500 was up over 1%. The NASDAQ was up over 1% at 1.25. The Russell 2000 was up 0.5%. And then the VIX, well, it shot down as quickly as it shot up yesterday, but it was down 7.2%. Crypto is doing very well. We're going to talk about Bitcoin as well and see how it did. But overall in the market today, if you look at this chart here in front of us, this is the advancers and decliners distributed amongst the market. And you can see the biggest green bar, most companies were up from 0 to 2%. And then we have the second tallest bar, which was a red bar, and those were companies that were down from 0 to 2%. So that's kind of where the stock markets fell. Not huge moves, small moves overall in the market, with the majority of the moves being in the green. So that's very interesting to look at as well. The stock market, which wasn't very good yesterday, if you look at it being as a down day, it was a great day for shopping and buying the dip, which seems to be a pattern amongst investors and traders, and it's worked out, at least since the March bottom of 2020. But the stock market, which was down big yesterday, is up big today in a rebound-minded trade that seemed to be very pragmatic, which had this feel to it like maybe it was more of computer systems trading than it was actual people trading. The Dow Jones added about 425 points, while we saw the S&P 500 and the Nasdaq gained more than 1%, and the Russell 2000 was up 0.5%. Mega cap stocks are at the core of today's rebound effect, just as they were at the core of yesterday's losses. And I'm talking about Apple, Microsoft, Amazon, Google's Alphabet, and Facebook. And Facebook, we'll talk about that too in just a moment. But they were all higher, rebounding from large losses yesterday, but also from notable losses registered over the last month or so. Although worries do persist over slow growth, high inflation, and of course, Evergrande. On the corporate front, Facebook, their shares were up today after a very bad outage that shut down its social media and messaging platforms yesterday. It was an awful day for Facebook. A Senate hearing took place today to address the Facebook whistleblowers' complaints, and there were some pretty serious claims made about Facebook's business practices. The stock market, though, is following form with a buy the dip trade following a day of large losses. This mentality, as I said earlier, has worked since the March 2020 bottom. But will it continue to be a good play going forward as the market continues to inch higher? Can we go higher as a market? Or are valuations stretched so far that the market cannot sustain this type of growth? Also supporting is investor sentiment. It was better than expected on the ISM Services PMI reading today, so that was good. On the political front, Senate Majority Leader Chuck Schumer said the Senate will vote on Wednesday to advance the Democratic debt ceiling measure. So we'll have to watch that and see if that unfolds or not. 8 out of 11 sectors continue holding gains, with the communication sector trading among the leaders. It did very well today. Key factors for the communication sector that drove its performance today included things like Netflix, which was the best performer in the sector, rallying to a fresh record high. The Wall Street Journal did report that production workers in Hollywood will go on strike because they have not been able to reach an agreement. That could affect Netflix and Disney and many other studios along with it. Twitter bouncing off its lowest level since early June. Facebook bouncing off its lowest level since early June. Towards yesterday's opening mark. DZ Bank did downgrade Facebook stock to a hold from a buy with a, I believe it was $350 price target. Senator Blumenthal reportedly said that he supports breaking up the company. Will that work out for Facebook, or is it just saber rattling or cage rattling that it's just all hot air and nothing will come from it? Or will Facebook have to face some regulation in the future? I think that's a big driver on why Facebook was down so big yesterday and wasn't able to retain those, wasn't able to bounce back from those losses as big today. Take-Two rallied back above its 50-day moving average to a 4-week high. Alphabet, or Google's Alphabet, reclaimed yesterday's loss, which is great. Comcast reclaimed yesterday's loss, though the stock went ex-dividend today. Disney rallied to its closing level from Friday before narrowing its gains, and Verizon rose toward its 50-day moving average, and Dish Network was the weakest performer in the sector, surrendering yesterday's surprising gains. That's what I saw in the market today. What did you see in the market today that you liked? Let me know in the comments. So let's hop over to the sticks here and see what our big winners and losers were for the day. So if we start off at the top, we got Bit Digital, and it was up 36%. Marathon Digital Holdings was up 10%. Bloom Energy, which was actually down yesterday, is up 8.9% today. Let's see, Hive, Hut 8 Mining was up 7.2%, MicroStrategy. So a lot of Bitcoin players were up today with substantial gains. Lee Auto was up 5.5%. Bitfarms was up 5.4%. GoodRx was up 5.4%. It's nice to see that company moving up. I like GoodRx as a company. I think they do a good job of helping people and lowering their prescription drug costs. Right now, the stock is sitting at $43.12, down just a fraction of a percent in after hours, but it's a company I like and to keep my eye on. Netflix up 5.2% to $634. It was slightly higher in intraday today. Let's see what we got. Coinbase was up. Again, these Bitcoin and cryptocurrency related companies were up today, but Coinbase was up 4.7%. We got Dogecoin. It was up 4.3% today. Yesterday, during our live stream, Dogecoin was sitting, it had just broken 24 cents. It is now at 25.35 cents right now. So it's up an extra penny since yesterday's live stream. Right, blockchain up, Square up. Square was up 4.3. Bitcoin is up today 4.2%, and it has broken the $50,000 mark. It is now sitting at $51,439. Bitcoin is set to move substantially higher, in my opinion. If you look at, and let's just hop over there to the chart. This is Pepsi. Let's pull up Bitcoin and just take a look at the chart for Bitcoin. Yes, I've got some crazy lines drawn on the chart here for doing some crazy trading. But if we look here, this is on a daily view of the stock. You can see it fell down here September 29, September 30 to around support that was around $40,800. And since then, Bitcoin has nearly gone straight up. And right now, it's at this resistant line for the day. And you can see it, the candlestick, the wick, it broke above this trend line, while the candle itself is sitting right on this trend line. And this trend line is right at $51,250. So if Bitcoin can stay above this trend line right here, meaning when tomorrow's candle forms, if it can stay above this trend line here, then Bitcoin, its next resistance area on the trend line isn't until up here around the $60,000 mark. Of course, it's got some smaller resistance areas up to that point, but from 51,000 to 60,000 really is Bitcoin's next big move that it could make. So if it can hold above this resistance line and turn it into a support line, then Bitcoin definitely has some room to run. All right, so let's hop back over to the sticks here. Let's see, we've got Xpeng, it was up 4.1%. DocuSign was up 3.9%. It's sitting at $256 a share. Let's see, NVIDIA was up 3.6%. It's over $200 a share now at $204. So it's on a run, and that is something to keep a closer eye on. Let's see, Ethereum was up 3.3% today. Litecoin, the Grayscale Bitcoin Trust was up 3.3%. So a ton of crypto-related stocks were up today. Affirm is back over $110. It was up 3.2%. Sprout Social was a big loser yesterday, but it's up 3.2% today. Arrival EV Play, that was down yesterday considerably, so now it's up 3.1% today. Good to see that jump. Let's see what else pops out. We got CarMax. It's up over $126 a share. It was up 3% today. Solar Company. Good to see solar up today. SolarWinds and CrowdStrike both up today. I would imagine they would be up today with Facebook's big problem from yesterday. Good to see cybersecurity stocks up. Let's see what else is up here today. Nano Dimensions, that was a company that went on a hot run earlier this year. It's sitting at $5.51 right now. It's up 2.4%. So, well, we'll see how that one's done. It's kind of faded back. For those 3D type of printing companies, I think they've got a big future in our market, and they can do very well. But since they're all so spread out and small and just getting started, it's really nice to just get a basket of them in an ETF. And I was just looking here. I thought I had, here we go, the 3D printing ETF. The ticker symbol is PRNT, and it's at $35.42 a share. It was up 1.6% today. So if you're thinking about the 3D printing space, that would be a pretty good investment if you're not sure which 3D company to pick. All right, so let's take a look at some of the losers for today. So we got, poor Lordstown Motors. They just keep getting beat up. I saw a report today for Lordstown Motors with the Foxconn deal, selling the factory, Foxconn investing in Lordstown Motors with $50 million worth of common share purchased. The report said that even that won't be enough to keep Lordstown Motors afloat. So they were down 11.1% today. They're at $5.20 per share. That company, it's losing. It's losing bad right now. Let's see. We've got Green Dot. It was down 7.6% today. That's a company that allows younger kids, minors, to invest with parents' permission. It's very interesting. If you have kids, that's something to look into. Let's see. Faraday Futures was down 7%. AutoNation, which is a car dealership, down 4.3%. Bed Bath & Beyond down 4.2%. Cheesecake down 3.7%. We got a space stock there down 3.7%. Ruth Steakhouse, they were down 3.5%. Penn National Gaming, you want to get into sports betting, That stock's down 3.5%. Another space stock down today, 3.2%. Carparts.com was down 2.9%. Caesars Entertainment, another sports betting, gambling stock, that was down 2.8%. Camping World, they've been doing, they've been kind of flat over the past couple months. They did well over the pandemic selling RVs, but they were down 2.7%. So as you can see, and here's Thor, they also make RVs. They were down 2.6%. So even though we have these companies that were down, and you can definitely see some correlation here with retail stocks and gambling stocks, auto stocks, they were down today, but they weren't down that much, 2 to 3%. Yeah, I guess that can be considered a lot, but it's not the 5% that we saw yesterday. Carvana, 2.8% down. Kohl's, which is a retail store, 2.4% down. Urban Outfitters, another retail clothing. BJ's, another big box store. Those two are both down 2.6%. Jack in the Box, fast food, down 2.1%. So we can, here's Vision Marine that I talked about yesterday. It's the Tesla for the boating industry. It was down 1.2%. Merck was down 1.8%, but it had a big run, so that's okay. SunPower, not good seeing a solar company in here because solars took a hit yesterday. But SunPower was down 1.7%. We got Denny's, which is restaurant, Ross, which is retail clothing, Winnebago, which is the RVs. So the RV sector took a hit today. Let's see, Score Media and Gambling, another gambling related stock, down today. So we're seeing retail down, we're seeing restaurants down, we're seeing RVs down today. Dollar Tree down, but again, they're not down by big amounts, 1 to 3% really at the most. So let's hop over here. This is an interesting site that I found. When you're researching companies, it's always good to know what's being talked about the most online. So this website, it's called topstonks.com, and it tracks what stocks are being talked about the most on different forums. For example, here, these are the top 10 stocks mentioned on Wall Street Bets over the last 24 hours. And when you're doing research, it's good to find these because sometimes these can lead to spikes in a certain stock when you're trading it, when you find this. So we see SPY, Facebook, Wish, Tilray, Alibaba, Smile Club Direct, GameStop, Clove, Talk, and rounding it out at number 10, Palantir. Those are the top 10 stocks mentioned on Wall Street Bets over the last 24 hours. So did any of those stocks do well today? Well, yeah, some of them did. So it's just a nice little extra bit of information that you can use when you're researching different companies. Pepsi reported its earnings today. It was up, and it's up in the after hours. You can see it had a little drag here early in the morning and then picked up and then kind of held that throughout the rest of the day. But on Pepsi's earnings, I just want to pull this up right quick. Oh, actually, I already have it pulled up. Here we go. So Pepsi, in their Q3 earnings, it tops estimates. They reported third quarter fiscal year 2021 sales growth of 11.6% year over year to $20.19 billion, beating analyst estimates of $19.39 billion. Organic revenue growth was up 9% for the quarter. Net revenue from Frito-Lay North America increased 6% year over year. Quaker Foods North America rose 2%, and PepsiCo Beverages North America climbed 7%. Latin America sales rose 27% year over year. Europe sales grew 9%. The gross profit increased 8.7% year over year to $10.8 billion. And the gross profit margin fell 145 basis points year over year to 53.5%. The operating margin was 15.6%, and operating income for the quarter rose 4.9% to $3.2 billion. The company held $6.6 billion in cash and cash equivalents as of September 4th, 2021. Net cash provided by operating activities for the 9 months totaled $6.6 billion. Adjusted EPS of $1.79 beat analyst estimates of $1.73. Outlook for Pepsi. They raised their fiscal year 2021 organic revenue growth outlook to 8%. Previously, outlook was at 6%. PepsiCo sees at least 11% core constraint concern currency EPS growth. Prior was 11% as well, and at least 12% core EPS revenue. Previously, it was also 12, so that guidance stayed the same. The assumption applies 2021 core EPS of at least $6.20 versus the Wall Street estimate of $6.24. So Pepsi is estimating that they're going to do a little under what the street is expecting them to do. Price action. Pepsi shares are trading higher by 0.16% at $150.44 at last check for this report. Now, if we look at the stock chart for Pepsi, ticker symbol PEP, you can see them right here. They closed out at $151.09, but they've been on a run since the 3rd of March this year, not March of 2020. They've been on a nice run and have recently started to pull back. After that dividend was paid out, that's when the stock started to decline into earnings, and then of course it found support right around the $150 mark is where support is sitting at for Pepsi at the moment. Below that is, just $1 away. We could probably put a box in here between $150 and $149 per share as kind of a support area. If it did fall below that, then the stock would probably go down to its 200-day moving average and test that as support. But it looks to be caught right now in support, and we'll see if it can hold it over the next few days. Right now, the company on the RSI, which is down here at the bottom of the screen, it is sitting almost oversold. Let's see here. It's sitting right at about 34 points. Anything under 30 points, so 30 and below, 29, 28, etc., that would be considered oversold. So it's sitting at 34, which puts it right there at the oversold mark, which is a good sign that the stock has found support and maybe a turnaround or consolidation will be its next phase. So we'll keep that in mind and watch that. All right, moving forward, don't forget to leave your comments and questions in the chat, and we will go over them. Thoughts on Workhorse? Well, ticker symbol WKHS for Workhorse. It's down. It was down big yesterday. Down again today. It's $6.90. I don't know. Excuse me. I'm not sure where the floor is going to be for Workhorse. What Workhorse has to do right now is it has to prove to investors that the company is worth investing in again. It's really as simple as that. The stock could continue to bleed out and it could go to $1. There's really no floor that I can see for Workhorse. I mean, because when you look at its history, you know, it hasn't really been this low. If we go all the way back to the beginning of this thing, no, I guess I take that back. It has been down to $1 before. So there is a bit of a floor. However, until Workhorse can prove itself, I guess what we're looking at right now, with it sitting at $6.90, it could very easily fall to $1. I'll put it that way. I don't like to say that because I personally like the company. Workhorse, it's got a good story. It's a good brand. It's just had its reputation has been beat up a little bit with the lawsuit with the USPS, with the management team not doing what's right, not doing the right thing. So it's put a black eye on Workhorse right now. So they have to prove themselves. The new leadership team, the new CEO, they need to put their head down. They need to work, and they need to prove to investors that the company has a future. That's what I believe Workhorse has to do right now to turn itself around. Let's go look a little deeper into Workhorse here for just a moment. I want to let's see. Yep, let's go here. WKHS. Okay, so if we look, the 52-week low is $6.77. So it can go down further for sure. If we look at analysts, what they're saying about the company, which isn't always the best, but if we look at what they're saying, 14% out of there's 7 analyst ratings here. So 14.2% say it's a strong buy. 14% say it's a buy. The majority at 71% say it's a hold. 0% say underperform, and 0% say sell. I know 7 isn't a big number, and 7 isn't definitely a large enough number to say this is what the majority of people are thinking. However, it's good to see, though, that these 7 different people with their different trains of thought and with their different price models for getting to what a company could potentially do in the future, they're all hold, buy, or strong buy. Not a single one is underperform or sell, even though we're not sure where a bottom might be for Workhorse. Once management turns things around and proves themselves, then we can see Workhorse stock reflect that. Now, if we look at price targets for these analysts, We've got the low end is $6. So maybe $6 could be the floor. I don't know. It doesn't look like there's a strong floor right now. The average price is $10.58, and then the high end is $20 a share. Obviously, that $20 a share, that's some analysts who are thinking that Workhorse must have something brewing. If it's not the USPS contract, there must be another contract that they're thinking in their mind Workhorse might be able to get. So, with the average being at $10.58, there is some upside to Workhorse's current position. If we look at institutional holdings, and this is the really big one I wanted to look at, there are 280 institutions holding Workhorse shares. So the percent owned of Workhorse share is 39.11%. Shares outstanding 123.95 million, according to this analytics tool here. Now, the type, we've got whether investors have increased, institutional investors, whether they've increased their shares, whether they're new institutional investors, whether they've decreased their shares, or have they sold out altogether. So that's the four options on this chart that institutional investors can do. So we've got 75 institutions have increased their shares by 9.34 million shares. We've got 47 brand new institutional investors buying 3.44 million shares. We have 62 current institutional investors who have decreased the share amount by 12.5 million. And then we have 59 institutional investors who have completely closed out their position in Workhorse, and that totaled 8.23 million shares for Workhorse. So it's interesting to keep an eye on this analytics tool, just to give you a sense of what institutional investors are thinking versus what retail investors are thinking. Hopefully, this information helps to answer your question on my thoughts on Workhorse. But the big takeaway is that Workhorse management, they need to put their head down, they need to work, they need to build the best truck they can build, they need to manufacture that truck, they need to sell that truck, they need to deliver that truck and get it on the road in customers' hands. And if the new management team can do those things, then the stock price will turn around. Obviously, it's going to take some time, and you could see some rubber banding of the stock with retail investors, pumping it up 5, 8, 10% one day. The next day it's back down. I don't think it's going to move substantially, or maybe the best word to use is materially, until the new management can prove that they have it under control and there is a future for this truck in the electric vehicle space. If you take a more macro approach and look at the bigger picture, then you'll see that the EV sector right now is so small, okay? And Workhorse is just one little tiny company in a little tiny space. So it's going to take some time for the space to grow. If we look at what Tesla just put up with around 250,000 vehicles or so, 240,000 vehicles manufactured, delivered in the third quarter, there is definitely momentum in the electric vehicle space. That is for sure. But this is going to be a 5-year, 10-year, 20-year play on the EV space. And all of us investors who are investing in Workhorse, who are investing in Tesla, who are investing in Lucid or Neo, we are all very early to the party. And there's lots of room for lots of companies to bloom and grow. So I hope that does answer your question about Workhorse. I'm excited about the company. I like the company. I really like the drone aspect of the company. So we'll just have to wait and see. Okay, moving on from Workhorse. And again, if you do have any questions, toss them into the comment section. We will go over them. All right, there's a couple stories I wanted to look at. One of them being Opendoor builds a $9 billion debt war chest to buy U.S. homes. Now, the U.S. housing market, I believe, is starting to contract, okay? Prices are starting to go down. You see listings, they're starting to stay on the market longer. They're starting to reduce their price as they're staying on the market longer. You're seeing more and more of these happening, especially in certain areas of the country. Here where we are in Northern Virginia, Washington, D.C. area, we are seeing house prices start to contract. So Opendoor building up $9 billion to go shopping, to buy homes when the prices are starting to go down is a smart strategic move. So let's just read a little bit about this article and then we'll talk about it. So Bloomberg reports Opendoor technology is adding billions of dollars in borrowing capability as it races to buy and sell more homes. The company, the largest of an emerging group of tech-powered home flippers called iBuyers, and this is something that Redfin also does, that Zillow also does. So Opendoor, it's not something that only they do. iBuying is open to a lot of these housing market fintech type companies. Okay, so it continues. Entered into an amended debt facility with a $3 billion limit, according to an October 4 filing. That move, combined with other recent transactions, allows the company to borrow as much as $9 billion through non-recourse asset-backed facilities. Opendoor's main business involves buying a home, making repairs, and putting it back on the market. Access to short-term debt is a critical ingredient in the process, which also depends on home valuation algorithms and networks of renovation contractors. It uses senior debt to pay for 80% to 90% of a given home and mezzanine, excuse me for mispronouncing that, debt for the balance. According to an August filing, the company's new $3 billion facility gives it room to acquire more than 40,000 homes based on an average home price of $350,000. The company would need more senior debt to reach that figure. 400,000 homes. If they're flipping that constantly, they've got to have a limit, right? What could their limit be? Could it be 10,000 homes a month that they could buy, repair, and sell to flip them? Is it less than that? Could it be just 1,000 homes? Whatever their monthly flipper rate, I'm not sure if that's been coined yet, I'm sure it has, is, then the better the company is going to do and the more profits the company will have. Let's see, it continues. Opendoor's main competitor, Zillow Group, has also tapped Wall Street for debt, seeking more than $1 billion in 2 unrated bond offerings. Opendoor was up 1.5% at 1928 as of 1:37 p.m. on Tuesday. The stock had slipped more than 16% this year through Monday's close. Zillow shares have also declined so far in 2021. After nearly tripling last year, the stock has dipped more than 35%. Yep, that is true. Both of these companies, we've got, let's go to the stock chart. Z for Zillow. We'll look at that first. And you can see that decline that they've been on after running up to a huge peak on February 16th of $208. They're down to $86.50. From $208 down to $86.50, that's a huge discount. As a matter of fact, let's measure that. I want to see what that discount is. So if we come up here to 208 and we come down here to 86.50, I got 86.46 within pennies there. So that's a 58% decline. That's incredible. 58%. What's changed with Zillow over this year? What has changed with Zillow in 2021? Has their business model changed? Has the environment in which they do business, has that changed? Well, the company hasn't really changed. They still have the same business model. They're doing more iBuying. The environment has changed where the housing market has started to slow down. So maybe their growth in the future isn't going to be as fast as it was last year. So maybe that's the reason for its decline. If that is the reason for its decline, then the stock is literally on a 50% discount. That makes this stock a potential buy because the housing market, while it's contracting now, the housing market consistently contracts and expands, much like lungs that are breathing. So as long as you're watching the housing market, and when it starts to expand again, that's when you want to watch for Zillow. And where's the stock at? Is the momentum still pushing it down? Has it found support? Is it consolidating? Those are all questions as an investor that you want to ask yourself before you dive into purchasing a stock. All right, so now let's hop over and let's look at Opendoor, which their ticker symbol is OPEN, O-P-E-N. And you can see, look, they had a big peak on February 11th. Their big peak was $39.24. And they are now down at $19.22. They have actually reversed trend. They reached their bottom and now they're moving up. So if we tag the top line here, right around $40, and we come down to their lowest price, which honestly might have been here on May 13th or right here, they're pretty darn close, on July 27th. But that was a 65% pullback from its all-time high. 65%. When you go into Walmart, do you look for items that are full price? Or do you look for items that are 50% off, 10% off? I mean, really, you go to Walmart, you're looking for things that are like 2 or 3 to 5% off their regular price, and those are the items that you buy. You have to think of stocks in the same way. Open Door at its lowest point on July 27th was at a 65% discount. So then ask yourself, has the business model or something significant changed with the company? No. Okay. Has the environment the company is working in, has that changed? What caused the stock to go down 65%? And if you can answer that by saying, it was market emotion that oversold the stock, it was housing prices were contracting, okay? When you understand the business model of the company, how it makes its money, and then when you understand the market that it's in, how do the consumers behave, you can then understand the business, which then allows you to understand where the stock should be. And is a 65% discount from all-time highs a great place to buy? Some companies, a 65% pullback from all-time high, it could show signs that the company itself is falling apart. It could show signs that the company was headed down the wrong path. New management had to come in, take over the company, and put the company on a different path. Workhorse is a great example of that. Management was putting the company on a dangerous path of bankruptcy. Now, new management has come in, and now Workhorse is on a different path. Yet to be seen if that path will work, but they're on a different path. Those are things to think about as investors. So when we see big discounts like this, ask questions, because it could be the buy of a lifetime. And I always go back and think about March of 2020. March of 2020 was a low that we hadn't seen in a while. And everything just fell so fast. People were worried about, oh my goodness, is this it? Is this like something that's happened in the past? Is it going to take years to get back to all-time highs? Well, in 2020, the answer was no. We were going to get back to all-time highs very shortly, within months. So it was a great place to buy, but you had to understand that as an investor. And like I said yesterday in the live stream, you have to take your emotion out of investing. You have to think logical and rational. Okay, so that's it on what I want to talk about on Open Door. They're building their war chest in order to buy more homes for their iBuyer platform project, where they can buy homes, fix them up a little bit, spruce them up, slap some new paint on, maybe put a new door on that got busted up, and then resell the home for a profit. So they're building their war chest for that. All right, next up, Generation Z. X. Generation X. Okay, we're going to talk about them now. Don't forget, leave a comment with a ticker symbol and a question, and we will answer it on the live stream. That's what this live stream is for. Okay. Gen X wealth has gone up 50% during the pandemic. That's a a lot of money being saved. That's a lot of money being invested. That's a lot of money for an entire generation to be holding on to. So the quick notes are assets rose by $13 trillion since Q1 2020, according to Fed data. Gen X, which suffered most during the 2008 crisis, has rebounded. This is reporting by Bloomberg, and they say, Generation X, the often overlooked demographic group squeezed between baby boomers and millennials, has experienced a wealth boom in the U.S. since COVID-19 was declared a national emergency. During the pandemic, household wealth I'm having trouble with this word here. Let me take a quick drink. Okay, there we go. Okay, during the pandemic, household wealth distribution had shifted from older generations to those who are reaching their peak earnings years. And this is according to data from the Federal Reserve. You know, I always had it told to me like this. 20s, that's when you're working out, you're figuring things out. Okay, what do I want to do in my life? Your 30s, that's when you start to build your connections, you start to build up your business, you start to move up the ladder. In your 40s is when you start taking advantage of all the moves that you were able to make in your 30s. And then your 50s, you're at the top, you're loving it, you're reaping the rewards from your investment, whether that's investment in a business, whether it's investment in the stock market, whether it's investment in yourself, which can be the best investment ever made, in my opinion. And then you retire in your 60s. That's how it's been laid out to me, as far as a roadmap for your life anyways. A very short and to the point roadmap anyways. But Bloomberg continues, Gen Xers who are aged 41 to 56 saw robust gains in equities and pension entitlements, while their share of the nation's consumer debt declined, the data showed. Here's a chart by Wealth Bloom. Aggregate net worth of Gen X household jumped by 50% since COVID-19. So we have the black bar, which is the silent generation or older. Then we have the pink bar, which is baby boomers, the blue bar, Generation X, and the yellow bar as millennials. And we can see 2020 Q1 to 2021 Q2. The COVID-19 crisis marks a rebound of sorts for the cohort that was worst hit by the 2008 financial crisis. Millions of Gen Xers who were in their 30s and early 40s at the time lost jobs and housing wealth. Let's see, it continues. Their careers have since stabilized, and those who could save money have increased in the stock market and 401ks, retirement accounts. As of June this year, Generation X held 28.6% of the nation's wealth, up 3.9% percentage points, that is, from the first quarter of 2020, according to Fed data. In dollar value, that translates into a 50% gain in their aggregated net worth, the difference between a household's assets and debts. The shares held by the so-called silent generation, born before 1946, and the boomers, the largest demographic group by far, declined in the same period. Another way to grasp the Gen X wealth boom, the cohort of about 34.6 million households added $13 trillion in assets over 15 months. That's more than the 12.8 trillion added by boomers, a group that included 7.7 million more households than Generation X. And it continues, the COVID-19 crisis and the housing crunch it generated hit when many of Gen Xers already owned a home, enabling them to capitalize on the boom. The younger millennial generation, who are aged 25 to 40, were less likely to be homeowners. Gen Xers also benefited more than the older boomers from a rise in pension assets. The youngest boomers are 57 and many have retired, meaning they are drawing down on their pensions. In 5 quarters, equity assets owned by Gen X households more than doubled to $10.5 trillion, according to the Fed data. That amount is now more than 10 times the stock holdings of millennials, yet only about half boomers' equity holdings. And we can see here on this chart the hefty gains here. We've got it broken down by color and segment: real estate, pension entitlements, consumer debt liabilities, consumer durables, private businesses, which is the yellow line. And you can see that has been increasing, and it is now, I believe, almost at the top, 34.5%. So private businesses for Gen Xers, it ranks among the highest of any of the other asset classes here. That is fascinating. So there were a lot of entrepreneurs in the Gen X generation. I find that fascinating. And then we have home mortgage liabilities and corporate equities and mutual fund shares to round out the rest of the colors there. So that is very, very interesting. And then we have the savings account here. It says baby boomers accumulated much more deployable cash than other generations over the past 2 years. You can see here, second quarter of 2019 to the second quarter of 21, and the change that has made. Pretty substantial. Okay, so that's it for the Gen Xers there. Make sure to leave your comment with your question and ticker symbol, and we will answer it live on the live stream at any time. So make sure to do that. Next thing I want to talk about, market patterns. Market patterns suggest the S&P 500 will have a good week. So S&P 500 tends to end up the week after dips like the one just seen. Stocks are rebounding as traders continue to bet on recovery. Come Friday, if history is any guide, the stock market will have staged a solid bounce back from last week's drop. The S&P 500 closed last week down 2.21%, marking its 18th weekly loss of at least 2% since the start of 2019. But according to data that bodes well for this week, since 2019, the S&P 500 has gained an average 2.1% in the week following a weekly loss of at least 2%. With dip buyers using the chance to swoop in, the benchmark has finished such weeks higher 12 out of 17 times, a 71% win rate. Wow, that is fascinating data to think about. When we look at the S&P 500, and we'll just pull it up here on the chart, you can see that since March 2020 and before that, it's just been a rocket ship up until the 8th or so of September, where it had its downturn, which was wasn't quite a 5% pullback, and then there was a bounce, and then now we have another drop. Are we going to see a bounce like we did right here for the rest of this week? Is that what it's going to look like? According to data, there's a 71% chance that there is a bounce this week. So I just find that interesting. So if we zoom in here, you see this all-time high here, and then we have this pullback. Let's measure it. We go to the all-time high, we measure to this dip, okay? That was a 5.4% pullback, and then we bounced up to be down 2%. So just like the data showed, it's just over a 2% recovery. So when we look at this, it was at 5%. We come up to 2%. That was a 3% recovery. And then we fell down to a total loss of 5.7% since all-time high. So it's suggesting that we could bounce up at least another 2%. And so far, we are, let's see, 5.8, and we're at 4.8. So we're at 1%. So there's another 1% remaining for the rest of this week, according to that data and prediction. I find that pretty fascinating. How about you? What do you think about that? Do you think we have a 71% chance of being green for the rest of this week? Let me know in the comments what you think about that. Don't forget, if you are watching the replay of this, leave a comment with your ticker symbol and question, and we will answer it in tomorrow's live stream. So I think I'm going to wrap it up here, unless there are any other questions you would like to ask. And I wish you all happy trading and good investing. And if there's no other questions, I'll give you just a few more seconds here. If you're going to ask a question, go ahead and leave it. Otherwise, I will see you in the next video. We have a video coming out on Tesla next, and that video is it's got 3 different topics. One being deliveries, one being their legal battle, and one being a special surprise that could net Tesla billions of dollars in profit. Absolutely. Okay, folks, I'm going to wrap it up here. Thank you so very much for watching. Make sure to smash that like button, share this video with your friends, and click subscribe to join our family of investors. And I will see you tomorrow or in the next video. Thank you so very much for watching. I will see you in the next video.